Video is being recorded on Wednesday, June 21st, 2023. Thank you so much for joining me today. Make sure you subscribe if you already haven't. I would really appreciate it. Thank you. And in this video, I'm going to talk about the secular trends in gold in the stock market. And with respect to each, the secular trend has not quite changed yet. Let me get into it. Okay, so just going to go over this chart today. This is the only chart in this video. So we have the S&P at the top, gold below, and then my expected returns indicator at the very bottom. That's the expected returns for a 60-40 portfolio. That's 60% stocks, 40% bonds. Now, this is a weekly line chart, and the moving average for the S&P I'm using is an equivalent to the 40-month moving average. Now, why do I use that? Well, if you go back the last 100 years or so, the 40-month moving average is an excellent indicator or demarcation point for secular bull and bear markets. Now, let me just work back. So with where we are here and now, you can see very recently, and again, this is a weekly equivalent, but very recently we could see here and then a couple times here, the S&P was able to hold above the moving average line. I mean, it came below it once there at the low in October. But other than that, it's been able to bounce. And look, I mean, it held above it a couple times. Part of the reason why it has some legs, it's been moving up. But, you know, working back, other than COVID, you can see here in 2018, here in 2015, here in, I believe that was 2011 or 2012. So all these times the market held above it. You know, here when the market, this was a rebound here above it. Then when it lost it, got into real trouble. Same thing happened here in 2000. And so going back here, I mean, let's look. This is that 1980? Yeah, it's 1982 or 1983. But we could see, you know, the secular bull gets started, holds above the moving average here, held above it there. So, I mean, held above it all that time. Then it lost it here. You know, same thing here. Hasn't quite lost it yet. Now, let's go back to the 60s and 70s. I mean, it worked out pretty well, though there were some times, I mean, it came below it here, but it really lost it significantly here. And so, you know, this peak was at the very end of 68, so 68 to 82, that's the secular bear. And so what's interesting about this period, 1964, 1965, that's when gold stocks made a major, you know, nearly a 30-year, multi-decade breakout. Now, the S&P hadn't quite gotten into a secular bear yet, but nevertheless, you know, by 1962, if you can look here, the expected returns in 1962, when the market made this peak, were already really, really low. So, yes, the secular bull here, it continued, but once you got to the early 60s, in real terms, the gains really petered out. As inflation picked up, you know, the gold stocks, a proxy for gold, broke out, and so that happened. But nevertheless, my point is, yes, the secular bull in the S&P continued after 1962, but, I mean, the gains were really, really limited here. I think from 62 to the peak here in 68, the S&P only gained 50% in the next 6 years right here. So really not that great. And again, after this decline here, you know, a year or so after that, that's when gold stocks made the major breakout. So in real terms, you know, it was really the mid-60s or slightly before then when the S&P petered out. And again, you go down here, you can see the expected returns were already terrible once you got past 1962. And I think we're seeing something, you know, similar this time around. But again, you know, the S&P is still continuing higher. But I think that, you know, as this has continued higher, I think the best case scenario for the stock market is you have this, you know, 62 to 68 period where, yes, you're technically not in a secular bull yet, but the returns are not going to be that great anyway. And so talking about that, let me get back to gold and how this all ties in with what's going on right now. So the secular trend hasn't changed because the S&P multiple times, I mean, it tested the 40-month moving average multiple times. Now it's rebounding. You know, now it's moving higher. Meanwhile, with gold, I mean, multiple times it's been trying to, hasn't been able to break out yet. I mean, it's gotten really close. It's holding up really well. And so, I really think that, when gold is going to make this big move and go into a real bull market, the S&P is going to have to come down. And, the trigger for that could be the coming recession. The coming recession, market sells off, loses the 40-month moving average. The Fed's cutting at that point. Maybe we're getting fiscal stimulus, and then boom, you get the big move up in gold. Secular trend has changed. But the point of this video is we're not there yet. At the very present time, again, gold failed again to break out here. Stock market has rebounded. So in a secular basis, secular bull market, the S&P is still going. Secular bear in precious metals, because if you say gold, people get confused, but it's really in precious metals. It's still going. And so, you need gold to really, not really, but, you need gold to make this breakout. That's in a new secular bull. And that's likely to coincide with the market rolling over and coming down. That's why I have these lines here of, potentially what could happen. As far as how much longer the S&P could run here, that's a matter of when the recession is going to hit. Look, if the recession isn't going to hit until Q1 of next year, and you look at when the market tends to fall off, the market tends to peak a month or two. That's historically before the recession really gets underway. So if you don't have a recession until Q1, this could run for 3, 4, maybe even 5 more months. I'm not predicting that. I'm just laying out the case here. And people are talking about a new bull market, but some potential analogs for the S&P in this move and how much it could run before a recession. Let's go back to 1966 here. 1966, you had this decline. Then you had this really wasn't that great of a move into the end of 68. Then you had the recession, bear market. So that's one historical comparison. And then also 1998. You did have this melt up in tech, but this was 1998 when a lot of people, the yield curve was already inverted. The tech stocks and internet stocks were going crazy. You had a melt up in those, not really in the general market, but the market kept moving higher. So I think 1998, 1966, those are some precedents that we can use to think about how much longer this move in the S&P could go for, could continue for. And so again, as long as the stock market is moving up here like this, gold is not going to break out. More capital is not going to come in to the market. So to the gold market, at least. So that's where we are. Secular trend hasn't changed yet. I do think it will at some point in the next 6 to 12 months. Thanks everybody for tuning in. That's all for today and in this video. Leave a comment. Let me know what you think. I'll talk to you guys again in the next video.